The Institute of Internal Auditors presents All Things Internal Audit. In this episode, Emmanuel, Pascal, and Dr. Ahmed Shawky discuss why greenwashing is no longer just a reputational risk, but also a governance and assurance challenge. Together, they break down how greenwashing qualifies as legal misrepresentation, why most control environments are far weaker than leadership realizes, and what a practical audit approach looks like. From mapping sustainability claims across channels, to using data analytics and intensity ratios, to test what companies report and what they don't.
For those who are not familiar, Dr. Ahmed, how would you define greenwashing and what could be the consequences for a company?
Greenwashing simply to me is misrepresentation of sustainability information. And that could be in any form, overstating, distorting, or omitting material information about the company's sustainability performance. And that's in practice, companies really cherry pick their sustainability, what they show to the public, showing only or amplifying their positive impact to the public in general.
Thank you. And that's very important that you mentioned the fact that there are some information that are omitted, because usually when I hear about greenwashing, I hear about communication. People talking about, is what we are communicating is good? Are we not going to do wrong green claims? So they are judging from what is said and not what is not said or omitted. And I think this is very, very important. And there are some very interesting cases where companies have concealed events and not disclose them. It's either in the US, there's a mining company that was indicted for this. And in Asia, there have been some incidents, like a milk company in China that have issues and did not disclose it. So that's very important. But at the same way, Dr. Ahmed, by the way, I'm surprised we're still talking about greenwashing. I thought it was over, as there is a backlash on this. And do you think it's worth working on it?
Yeah, the political backlash is real, but it's mainly coming out of the US. Most of stakeholders actually haven't moved and still strong believer in business responsibility and in business sustainability. So, for example, in Europe, regulators here are investors, consumers. They still need credible sustainability data to make informed decisions. So the demand hasn't really gone anywhere. I think it's only the hype and the rhetoric has shifted for some people in the specific regions only. We see, for example, you and I have seen the risk in focus 2026, 2025, still climate change and regulatory change amongst the highest risks across all regions. But you know that there is a really widening gap between political noise and regulatory reality. And this is where most audit committees really get caught and blindsided.
One question I will have, and we're going to talk about fraud after, but how can we consider greenwashing as a fraud? In what way could it be illegal? Are there laws about it? I know you're a specialist on this type of laws. That's why I asked you.
So the greenwashing is legally treated as misrepresentation. The core construct is the same as the financial misstatement. We have seen Enron case, for example, that was a financial misstatement. The same construct legally applies to non-financial data, which is sustainability data or business data. When organizations or business make sustainability claims that are false or unsubstantiated, they are misleading the public, the market, the consumers, the investors. And that's a clear misrepresentation, and regulators are treating it as such. For example, there are three regulations here in the UK for anti greenwashing. The first one from the Financial Conduct Authority, the FCA, the UK, they have that's enforced. It's called anti-greenwashing rule. That's enforced since May 2024. It applies to every authorized financial institution in the UK, and it requires that their financial claims must be fair, clear, and not misleading. The second authority is the CAM, the Competition and or CMA, I think, the Competition and Market Authority. Under the Digital Markets and Competition and Consumer Act since April 2025, last year, The CMA can directly now fine companies up to 10% of their global turnover. That's equivalent to GDPR, and no one is noticing really. And the minimum is, I think, 300,000 pounds. Even those penalties happen even without going to court, and there are daily penalties on top of that until the breach is remediated. In January this year, the CMA published the new supply chain guidance where companies are now liable for green claims they repeat from their own supply chain, from their suppliers, not just the claims by the originate. Thirdly, and finally, here, the Advertising Standards Authority, the ASA, in the UK, continues to show also a sustained focus on environmental claims as retailers were using green claims as advertisement campaigns. Those are the three main examples of three main regulations here in the UK alone. And also, in addition to that, you have now requirements from the IFRS Foundation within the ISSP about climate changes, specifically GRI disclosures, and so on.
And as you were talking about GDPR, I was thinking, and everyone knows that the UK are not in the European Union now, but they are also another law in Europe that is happening called empowering customers, and I think it's going to be a shock in Europe because some people are not understanding the consequences of this law, because it's going to affect sustainability labels, and a lot of companies are labeled for customers but also for third parties, and also it's going to talk about green claims for customers. Also, as you mentioned, you mentioned the UK, but there are also a lot of reporting laws in place or under development in Asia. I know that China is very hype on developing reporting claims. And as you talk about GRI, there are also, and IFRS, there is a lot of development. So I think we talk about fraud, and I'm going to explain what makes greenwashing different from other traditional fraud, classic fraud. And the first thing I wanted to say is that there is a concept I developed a few years ago called the value fraud, and I train my students in Dauphine University in Paris on it. It's about when companies are lying about the value they create for their customers, for their stakeholders. Usually at first it was quality, and now as sustainability, it became a value. It's greenwashing is for me a good example of value fraud. There are different types of things to consider for auditors when they look at value frauds. The first thing is a fraud triangle. It's completely different from a traditional, I would say, financial fraud. The second thing is a gain, because it's going to be wider than financial gain, because sometimes people can commit greenwashing because they want to stay still, because they don't have the same corporate culture, they disagree maybe with the goals, or they want to challenge the company. If we take the Dieselgate, that could be a good example where companies, there were no financial gain, but within the company, maybe the engineers wanted to challenge and say they were right about their work. Also, what is important when we talk about greenwashing is the scope is going to be wider, and then just a group. When we talk about financial fraud, we just consider the company or the group, but here the scope is going to be wider because we are going to assess the fraud within the value chain. That means the customers, the third parties, the inflows in the company, the suppliers, but also the customer. So it's a wider area. And I will talk about it during my presentation in the international conference of the IA in Singapore in June. And I will explain about a case on about subcontractors of luxury companies in Italy. So this third party is very important. And also in this fraud, we are going to use different data. We are going to talk about data after. And one of the things that is important in this data is that the origin they are different because they will be about not financial, but operational, but they can be very strange, like temperature, they can come from probes, sensors, and so that could be very different to handle than when you are usually looking at data from an ERP system. And last thing that is different from traditional is that there is an opportunity, and that's it's not an advice I'm going to give to the audience, but there is, according to me, a weak control environment right now in the company, and a lot of companies are ripe for greenwashing because they are not looking at their controls right now. So there's also an opportunity for internal auditors to look at this, because a lot of companies are just happy to achieve, to report and comply, especially with CSRD in Europe. And now they need to digest. And I talk to a lot of companies that say, oh, we are happy to report, but when I ask them for internal controls, they are a bit lost. So that's the interesting difference I see with the traditional fraud. And now, Dr. Hamed, sorry, how can we assess greenwashing risk for you?
Before we go into how we assess greenwashing as a risk, because I believe it should be a embedded part of the risk assessment process, I totally agree with you. Sustainability data is all business data and it's fragmented data. So it's unstructured in nature. And it's usually happened due to misalignment across the entire organization rather than happening from an individual fraudster. And I totally agree with you that it is mostly a control environment failure. That's in general. So, how can we assess the greenwashing risk and possibly mitigate that risk to happen, to materialize? I think first we need to understand auditors and audit committee need to know what that is. They need to cope up with that evolving landscape. The audit committee has to clearly include sustainability oversight within their audit charter from risk management and assurance point of view, not from operations. The operation should be out of the audit committee scope. And then for auditors to really map their sustainability claims across every channel, from marketing channels to operational to disclosures to reporting, annual reporting, and they make sure that they apply the respective regulation across all of those channels. We must stress or should stress tested their each claim against some of the regulatory requirements, even if they are just voluntary in the region. For example, the CMA green claims in the UK have a great framework that can be applied as even a good leading practice somewhere else out of the UK. And that simply applies some principles and rules, like being the claim must be truthful, clear, no material omission, fair for competition, and covering the whole life cycle. And it should be substantiated. So there has to be evidence against each claim the company would make. Because we have seen many cases. I'm happy to speak about some of those cases later on. But finally, there are some green claims governance solution available in the market to prevent that risk to happen. So organization now should, and auditors should leverage technology and have solutions in place to prevent the green claims from being materialized and cause greenwashing tendencies or cases. That's a brief overview.
Thank you. I wanted to ask something. Wanted to add something. Sorry, about the assessment of greenwashing. To say, this is something I say to my students. They need to consider the strategy of a company, and I think there is a strategy could be green. They want to be green or greener. Green means that they want to be in line. They want to be on the track, and greener. We want to do more. So I mean, the red flag would be to be greener, of course. So they need to consider the strategy of the company, and do they have the means to be greener? You were talking about technology, Dr. Ahmed, and I think that to be able to fight against greenwashing, we need to use technology. That's what I will explain in Singapore. The use of different technology. And for the first thing I would say, I will talk about data analytics. And I think data analytics will be very efficient because we will have to cover a complex and wide environment. So there are many information. And data analytics will be an additional resource because we know that a lot of internal audit teams are lacking resource. And I like to say that data analytics is either you obtain an augmented auditor, or you obtain an additional resource. And so data analytics is going to be very helpful. But the difference with finance is going to be that there is no real specific pattern. Because as we say, from experience, we have seen so far, we said the control environment is weak, so we have seen very simple fraud so far. So the real thing here is to check the disclosure, to check the figures, to check what is communicated, and we'll see after that we can also check what is not disclosed. But the real thing internal auditors need to do right now is to check, as you said, Dr. Ahmed, if it's supported, if it can be checked. And there are many ways to deal with many type of tests, but I will just focus on one that is very interesting, called the intensity ratio. The intensity ratio, you can find them in reports, an extra financial report. And for instance, it's like you're a cruising company. So we are going to look at your carbon emission weight by per kilometers. Or you're a beverage producer, and we are going to consider the liter of water you are going to consume by liter of products you are producing. And so this intensity ratio, it's helping us. It's a KPI that is going to help us compare with other companies, with other entities also within a group, to identify if there's unusual items, if there's unusual reporting. One is the other thing we can do with data analytics is review third-party data, and we can ask, but this need to be very documented and very authorized, very specific in the report, either in your code of conduct or with your supplier or your contract, and you are going to audit the data from your third party. I will share an example in Singapore. The other thing is that I'm talking basically about structured data, but the other type of data is non-structured. Non-structured is about text, videos, everything that is produced, that is not in line, could be not in Excel. And in this non-structured, you need to identify mistakes and omission. And you are going to use different techniques, artificial intelligence, but also text mining. And the scope is wide because you have to consider your reporting, but also everything that is produced by your company and communication. So that's a lot of things to do with data analytics and with AI to identify. Last few questions, Dr. Ahmed. What could be a strong audit approach to start with control framework? You explained before that you need to find support, but we need to also, I believe, test the control framework. We've seen it's weak. Do you think of other things?
I would love to just to add to what you just mentioned, if you allow me, before I move to the audit approach itself, about the control framework, as you mentioned, just to summarize, to me, from what you said, there are four elements of that good control framework. One is the data analytics for continuous controls. The second is third-party due diligence, as you rightly said. And I would like to add to that that policy and the training. Every control fails without the people understanding why it exists, the purpose. So sustainability literacy, like AI literacy today, is very critical across the three lines. And the fourth element for me is technology, a platform that brings the data together, that fragmented data, bringing that together to avoid the break in that data. So having a data lineage, having a platform that brings the entire sustainability data in one data model is extremely important. Now, building on that framework for a good audit approach, I think that was the question. So I think there are at least three foundations to that. The first is internal auditors should really engage with the sustainability team, should be part of the climate risk assessment. They should be speaking the same. My observation from my research and on the field now, that sustainability professionals they have totally different risk criteria and risk assessment criteria and the metrics than what we use in internal audit and risk management. So internal audit and risk professionals engaging with sustainability professionals to synergize on the same climate risk assessment approach and the criteria, materiality assessment approach, the IRO, the impact risk and the opportunity, and the building on that, building their risk and control metrics on those spaces. What policies exist? What controls exist? Who owns that across the entire organization? Bringing that in harmony. Second is, again, education, training, educating the auditors, educating the audit committee. So we have responsibility to even educate our own audit committee and the entire organization under our advisory hat. Thirdly, orchestrate, synergize, orchestrate your risk assessment language with the entire organization in general. Those are the three points I would like to bring under a strong audit approach to mitigate the greenwashing risk.
Yeah, thank you. And I think this is very important to educate internal auditors about sustainability. So for 2 years now, I have set up a specific training for my students in EMLV Business School, and I train them to do a lot of things. They know what is value chain, they know life cycle, they know a lot of things, and now they know how to read reports and to audit reports. So it's really important to train them and to practice to look at use case, look at greenwashing. So we are working on different use case so that they identify what is wrong. We have role-playing games as well to say that I ask them to make false green claims for companies to see if they were able to design them. I would like to ask you, Dr. Ahmed, what is your favorite greenwashing case?
I wouldn't say favorite, but one of the main cases that really stuck with me, and it's in the Financial Times, is in the news, is the DWS, the Deutsche Bank's asset management arm. In April 2025, DWS agreed to pay 25 million euros to the German authorities to settle greenwashing charges, on top of another 20 million that they paid to the SEC in New York, with total exposure around $50 million. That was just, I would say, one of the recent cases. Plus, there were a number of other consequences happened to the DWS. Their market value declined by around 15% when that was disclosed. Their senior leaders, including the chief executive officer, stepped down from their role, and there were a highly damaging reputation fallouts, including, the police raiding their offices in Germany. And that's all because their public claims included things like a leader in ESG, and ESG is integral to our DNA. Prosecutors found that those statements didn't really correspond to reality, and they were not backed up. And what makes this case, I think, is interesting to internal auditors is who blew the whistle. So the DWS case came into picture due to the whistleblower from their former head of sustainability that was dismissed due to her disagreement with management about making claims without being substantiated. And that's simply the gap between what's externally said and what is demonstrated or being defendable internally. And that's where audit committee and the internal auditors is meant to operate.
So thank you very much, Dr. Ahmed, for this conversation.
Thank you.
Interested in hearing more from Emmanuel Pascal on greenwashing? You can catch his full session at the 2026 Singapore International Conference from June 22nd through the 24th. From IA and cyber resilience to fraud, governance, sustainability, and the future of internal audit, the conference brings together professionals from around the world to tackle the biggest challenges facing the profession today. You can attend in person or virtually and earn up to 39 IAA CPEs. You can find the link to register for the conference in the episode show notes.
If you like this podcast, please subscribe and rate us. You can subscribe wherever you get your podcasts. You can also catch other episodes on YouTube or at theiaa.org. That's THEIIA.org.